A business has been operating, it has earned business income, and it is coming to the end of the year. As we are coming to the end of the year, we are supposed to go ahead and file what we call an income tax return. Of course, this income tax return is a function of tax accounting. In today's session, I simply want to give you an overview, or call it a bird eyes view, of what a tax accountant actually does. So let's get to it. Of course, my illustration here, as I am going to tell you what a tax accountant does, I am trying to, it's going to be based on a person that is earning business income. Who is a person? According to the Income Tax Act of Uganda, a person could be an individual, a partnership, a company, a government entity, or a trust. That is what we mean by a person. And according to the imposition of tax, income tax is imposed on a person. It is imposed on a person that has earned, or a person that has chargeable income, and this chargeable income is supposed to have been derived during a year of income. If we are to talk about what a year of income is, there are three categories of years of income. We have the normal year of income, we have the substituted year of income, and we also have the transitional year of income. Those categories shall be a discussion for another video. In today's session, we are going to just dive deep, a bit deeper into what, just a bird eyes view of what a tax accountant does. And of course, the main work of the tax accountant is to derive the chargeable income, because income tax is imposed on what we call chargeable income. So now, of course, when the year gets to an end, there are some activities that have been taking place. The transactions that have been going on, from which the revenue has been derived. Of course, these transactions are tracked down by a bookkeeper. The bookkeeper keeps the books, and through the accounting processes and rules, double entry and all that, the bookkeeper is going to come up with what we call a trial balance. So when the bookkeeper gets the trial balance, prepares the trial balance, then the bookkeeper is going to hand over this trial balance to the accountant. So the accountant is going to get the information in the trial balance and prepare financial statements. Then after these financial statements have been prepared, then the tax accountant will come and take over. So there are three functions there. They can be performed by three different people, or it could be the same person. We are talking about bookkeeping, from bookkeeping to accounting, then from financial accounting to tax accounting. Let me share my screen and try and illustrate what I'm saying a bit further here. So from what you can see on the screen, we have what we call an extended trial balance. And in this extended trial balance, if you look at this part here, this is the part where we are having the one that I've just highlighted. It's what we are having. This is the trial balance, the work of the bookkeeper. I've labeled it as an unadjusted trial balance, from what you can see. Unadjusted trial balance. Then the accountant takes over. When the accountant takes over, he's going to go ahead and pass adjusting entries so that they come up with what we call an adjusted trial balance. Ooh, the English. An adjusted trial balance right there, okay? And then it is from the adjusted trial balance that we shall come up with the profit and loss account. So now these financial statements, I prepared them for purposes of this video. So we are going to go straight into, just to take you through the financial statements of the financial accountant, what they did. So when we are to come to financial accountant, to the financial statements here, I'm going to scroll through. From here, what you can see, if you come to the statement of financial position, it is a financial statement, okay? We'll call it the balance sheet. Then I will scroll down here to the statement of comprehensive income right there, which is the income statement, okay, That's the other name of it. Then we have the statement of changes in the owner's equity right there. Then we also have what we call the cash flow statement. So according to the financial accounting laws or the International Financial Reporting Standards, there are basically 4 financial statements to prepare at the end of the trading period. But when we are going to do taxes, we only need 2 of them, and that is the income statement, which you may call the statement of comprehensive income, and the balance sheet, or which we will call the statement of financial position. So we shall only need those 2. But of course, the financial accountant is supposed to prepare all the 4. We do not prepare, preparing financial statements for purposes of taxes should be the last reason why one should prepare financial statements. There are weighty reasons why one should prepare financial statements. For example, to assess the performance of a business, to look at areas of improvement. The issue of taxes should be the list of the reasons why someone should prepare financial statements. So yes, so like I said, from bookkeeper to the financial accountant is going to go ahead and prepare the financial statements. So when they go ahead and prepare the financial statements, we will go ahead and use those financials in other words, the tax accountant comes and takes over. When the financial accountant comes and takes over, his role is to try and derive the income tax that is supposed to be paid. How does he do it? Let's look at the profit or loss. Now we all know, of course, that income tax comes from if an entity has, if I'm to use layman's terms, if an entity makes profits, then that entity should pay income tax. If an entity makes a loss, it means there is no income tax to pay. That is if I'm to use layman's terms. And if I'm to use the illustration the financial statements that I'm using to explain this video, if I'm to scroll down here, this is exactly what is being shown here. So I've come here to the statement of comprehensive income, I'll call it the income statement. If I'm to scroll down here and we look at the profit or loss before tax right there, okay, I may highlight it. The profit or loss before tax is 72 million, as you can see. So this 72 million, like you're seeing, if I'm to go ahead and say, okay, this is the profit. Business income for companies, they pay tax at 30% according to the prevailing law as I'm making this video. So if I'm to go ahead and multiply this figure by 30% here, let me do it from here, just here. So I'm going to say that it's going to be equal to this figure, the profit before tax, and multiply that by 30%. So I'm going to say times 0.3 right there. So what do I have? You'll find that I have 21 million, okay? From what you can see, I have 21 million. But then the figure that you're seeing here for taxation, the figure you're seeing here is 27 million. So you will ask yourself, why is it that if I multiply this 0.3, or if I multiply this profit that the financial accountant got, if I multiply it by 0.3, why is it that I'm getting 21 million, yet here I am seeing another figure of 27 million as the taxation liability? Why? The reason is because the truth is we do not use the accountant's profit. In other words, the profit that has been used by the accountant is not what we use when we are going to go ahead and compute for the tax. It's not what we use. So the tax accountant is going to use another kind of profit. And this kind of profit that the tax accountant is going to use is after applying some adjustments. These adjustments the tax accountant is going to use are adjustments that have been made with the guidance of the provisions in the Income Tax Act. So the tax accountant is supposed to be knowledgeable with the Income Tax Act. He's going to use the law to make necessary adjustments so that the work of the financial accountant is optimized to be consistent with the prevailing tax law, then when the tax accountant does that, he comes up with what we call the chargeable income, or in a layman's term, I could call it the tax profit. So we have the accounting profit, then we have the tax profit, which is technically referred to as the chargeable income. So it is the tax profit that we are going to use to derive or to impose the 30% tax rate, and then we shall end up with our taxation liability. So let me illustrate this further with some write-up here. So this is what the financial accountant does. So when the financial accountant was preparing the financials, this is the formula they used. They used sales, or call it revenue, okay, minus the cost of sales minus the expenses, and they used that to arrive at what we call the gross profit. To arrive at what we call the profit, and this is the profit before tax. That is what the financial accountant, the formula the financial accountant used. But like I have mentioned, or like I have intimated, that if we get this profit and we apply the 30%, we multiply that by 0.3, from what I have illustrated, you are able to see that we got a different answer from what is actually there. Why? Because the tax accountant is not going to use this. Instead, the tax accountant is going to use what we call it, and is going to derive a tax profit. That tax profit, or technically referred to as chargeable income, is what we are going to use. According to the Income Tax Act of Uganda, income tax is imposed on a person, and that person is supposed to have chargeable income. Like I said, the person could be an individual, it could be a partnership, it could be a company. That is what we mean by person. So, or a trust. So the person is supposed to have chargeable income. This chargeable income is supposed to have been derived during a certain year of income. This chargeable income is gotten by getting what we call a gross income, and we deduct allowable deductions. So in other words, think about it this way. The financial accountant got this profit by getting sales minus cost of sales. But according to the tax accountant, for him, he does not call it sales. He's going to call it gross income minus whatever you deduct as costs, whereas the tax accountant is going to, the financial accountant will call it cost of sales and expenses. The financial accountant the tax accountant has a different language for that, and he's going to call it allowable deductions. So gross income minus the allowable deductions is what we are going to end up with as chargeable income. So the tax accountant understands this language. So the gross income is what constitutes gross income? What constitutes gross income is prescribed in the Income Tax Act. What are allowable deductions? What constitutes allowable deductions is prescribed in the Income Tax Act. And when we subtract these two, gross income minus allowable deductions, then we come up with chargeable income. So it means that the tax accountant is going to pick up from this profit, okay? And he's going to convert this profit into chargeable income. How? They are going to do so by reviewing the work of the financial accountant. They're going to see, okay, what did the financial accountant declare as sales or revenue? And then they'll ask themselves, what the financial accountant declared as sales or revenue, is it what the Income Tax Act recognizes as gross income? If yes, it will remain. If no, it will be adjusted. Same with this. The tax accountant is going to look at the cost of sales and is also going to look at the expenses of the financial accountant. And he is going to ask himself, okay, these expenses that have been declared, are they what the Income Tax Act describes as allowable deductions? If yes, they will be allowable. If no, they will be disallowed. So these adjustments is what is going to convert this profit into chargeable income. So that is when we are computing tax computation is going to become the profit according to the accounts. Okay, the profit according to the accounts, that's the figure we are going to start with, and then we are going to add back. We are going to add back the things that are non-allowable. Okay, then we shall less the allowable deductions. So we add back, okay, non-allowable deductions and then less allowable, and then we shall come up with our chargeable income. Now this chargeable income here, this chargeable income is also the same as our tax profit, and this is where we impose our 30%. Okay, so that is just an overview of what a tax accountant does. So the tax accountant is supposed to be knowledgeable in the provisions in the Income Tax Act. Let me give just a few examples based on our current tax law. We might find that, for example, you might find that under the expenses here, there is depreciation. So according to the internal accounting policy, depreciation is considered an expense. But according to the tax laws, depreciation is not considered as an allowable deduction. So whereas the financial accountant considered depreciation, here it is going to be disallowed. So part of the things that you're going to add back here as disallowed is going to be depreciation. Why? In other words, you are trying to reverse what the financial accountant did, and you're doing it because you want this formula, okay, to be conforming with the tax laws, and by it conforming with the tax laws, you're trying to convert it into this formula. So if, for example, here there is some of the things, there could be depreciation, there could be startup costs, there could be things like startup costs, depreciation, there could be meals, and so on. I'm just giving examples. So depreciation is an expense according to accounting rules. Startup costs is an expense according to accounting rules. But when it comes to tax, the tax code, as of the time I'm making this video, they are not allowed. So we are going to get this accountant's profit and we shall disallow them. So we shall subtract the profit less. We add them back to the profit. By adding them back to the profit, it means that we are reversing what the financial accountant did. So we add them back to the profit. So that is the thing. So we add them back as non-allowable deductions. And then, of course, then down here we shall go ahead and allow and make the allowable deductions as required. Okay. Of course, instead of depreciation, there is a special kind of depreciation that is prescribed by the tax body, and we call it wear and tear. So we disallow depreciation, or we reverse the deduction made by the accountant by calling it depreciation, and then instead what we shall allow as an allowable deduction is the wear and tear. So we shall add back depreciation and less the allowable deductions. We shall come here and say wear and tear, something like that. Okay. Meals, you might find that in the an entity, according to the accounting laws, meals are had. There are some meals that are served at the premises of the business. There are some meals that are served by to maybe top executives in Serena. There are some meals, you know, that are served to workers in certain hotels somewhere that are not, you know, at the premises, and they are all allowable according to accounting laws. They are all expenses. But when it comes to tax law, it says that meals are supposed to be served on equal basis. So that simply means that as far as the tax code is concerned, as for the time I'm making this video, the only meals that we shall accept as allowable deductions are meals that are served on equal basis, probably at the company premises. That is what is allowed for tax purposes. So it means that whatever that the financial accountant had included as meals that does not serve or does not fit the prescription of what is allowed as a meal according to the Income Tax Act, that is going to be scrapped off. That is going to be added back to the profit so that it is taxed. You get? So it's the same when we come to sales and revenue. You might find that the financial accountant here, in this figure for sales or revenue, they included rental income. Okay? But according to our law, rental income is not supposed to be part of gross income. Why? Because rental income is taxed separately. So these are the things that the tax accountant is supposed to find out and make the necessary adjustments to the profit. You might find that in the sales or revenue, the financial accountant, part of the revenue, he included revenue that was earned, but on that revenue that was earned, withholding tax had been imposed on that revenue as a final tax. So the tax accountant comes and sees that, and he makes the necessary adjustments because that revenue is not supposed to be part of gross income. You know, the other categories of incomes that are not supposed to be part of gross income are incomes like, let's say, incomes from a small business. We shall talk more about small business income tax filing in another video. Then things like exempt income. Of course, when it comes to the International Financial Reporting Standards, well, you will report all kinds of income on someone's under sales or revenue. But according to the Income Tax Act, there are certain categories of incomes that are exempt from tax. We call them exempt income. Those ones are not supposed to be featuring in the gross income. So all these are the adjustments that the tax accountant is supposed to be making. And when the tax accountant makes all these necessary adjustments, then we shall end up with what we are terming as our chargeable income. So when you see this figure here for taxation here, it is as after all those adjustments have been made, the allowable deductions, the non-allowable deductions, then we shall end up with the chargeable income. And so the chargeable income is where the 30% is imposed. Now, where does this tax computation take place? This tax computation takes place at the very bottom. If I may scroll back up to show you just how these financial statements flow. We have, for example, here we have the statement of financial position, okay, which is the balance sheet. Then it takes us to the statement of comprehensive income right there. Then it takes us down here to the statement of changes in equity. Then it takes us to the cash flow statement. Then we have, of course, the notes to the accounts come next, okay. Right here, the notes to the accounts are the ones that show us the breakdown of the figures in the financial statements. Then now all these things are done by the financial accountant, and then after the financial accountant has done his work, then we come down here to the mighty tax computation. So from the mighty tax computation, like I have been explaining, we start with profit or loss as per the accounts, okay. Then we add back things that are, the things that the financial accountant included in his expenses that are not supposed to be are not recognized as allowable deductions in the Income Tax Act are added back. For example, depreciation, startup costs. These are just two examples, but it could be a whole list of things here. Again, where do we get this? It depends on what the financial accountant has done. It's the financial accountant's work that gives us what to do here. So we add them back so that they be taxed. Then less the wear and less the allowable deductions. That is when we have the wear and tear. The startup costs are brought back here in the prescribed format as per the Income Tax Act. Okay, we have other allowable deductions that can go down there. This is just an illustration for this video, but it could be more depending on the nature of the financial statements. Of course, part of the allowable deductions, also we have the loss brought forward from the previous period. In this case, we are talking about the assessed loss, not the accounting loss, the assessed loss. And then we will come up with the taxable profit. This taxable profit is what we are calling the chargeable income. And that chargeable income, that is where we impose the 30%. Now, speaking of what I mean by assessed loss, here we are talking about, it's just a language issue. Up here, we said sales minus cost of sales is going to give us the profit. What if it is a loss? What an accountant here calls a loss, in the tax language, the taxman will call it an assessed loss. So if you're having an assessed loss, after computing gross income less allowable deductions, the moment you get your assessed loss, this assessed loss is carried forward to the next financial year, and this assessed loss is carried forward to the next financial year as an allowable deduction. Okay, so that's the thing. So of course you cannot have an assessed loss carried forward from the previous year, right, when the business is just beginning. These are financial statements for a business that has just begun. So from what you can see here, then we have our corporation tax here, which is 27 million. Of course, then in case you have your tax liability as 27 million, then you can go ahead and deduct the taxes that have been paid in advance. Taxes that have been paid in advance include things like provisional income tax, that is tax paid in advance, then tax credits coming out of withholding tax on income tax. You know, we have withholding tax credits, like withholding tax credits. This is a form of income tax that is paid in advance. So you subtract them from you deduct them from the tax liability that you have come up with, and then you come up with the final tax payable. Okay, the actual tax that you're going to pay. So this is just an overview of what a tax accountant does, and I hope you have understood. To recap, like I said, it starts from the bookkeeper preparing the trial balance. This trial balance is then handed over to the financial accountant. The financial accountant prepares the financial statements, and then eventually the tax accountant comes in to optimize the financial statements to be in conformity with the Income Tax Act, so that we are able to find the actual income tax assessed. Now, this could be 3 different people, it could be 1 person. The main issue here is the knowledge that is required to do the certain things. A bookkeeper requires knowledge on double entry bookkeeping, period. A financial accountant should be knowledgeable with the International Financial Reporting Standards on how to prepare the financial statements. Then the tax accountant should be knowledgeable with the Income Tax Act of Uganda, because the Income Tax Act tax laws are the ones that he is using to interpret the work of the financial accountant, so that he optimizes the work of the financial accountant in tax terms. So that's it. The purpose of this video was to give you a bird's eye view on what a tax accountant does, and I hope you have understood it. That's what a tax accountant does. So as we go on to do the income tax return, you have a better understanding of what goes on. Let's take also note here that the illustrations that I've used in this video are based on business income. You know, there are different kinds of income. We have property income, we have business income, we have employment income, we have rental income. So my illustration here is based on a person that is earning, business income. So if a person is earning business income, they are required to prepare financial statements. But not everyone that earns business income prepares financial statements. There are those businesses that are operational that do not prepare financial statements, but they go ahead and file a return of income. Those are they're called the small businesses, and we shall discuss those ones in another video. So that's it for today. My name is Arnold Kisembo Ragakuramya, and this is Kisembo Business. Thank you for watching.